sterling was hammered to a 7-month low against the dollar overnight, while euro sterling is back pressing 0.87 on rumours that S&P are preparing to downgrade the UK's sovereign rating. While the rumours turned out to be ungrounded, there was little buying interest in the pound to help it recover ahead of the Bank of England minutes to be released today. Sterling remained the weakest European major since the start of the year on concerns of a triple-dip recession as well as the risk of failure to meet deficit targets. Bank of England Monetary Policy Committee member Wheel also mentioned the need for further easing to push the pound lower. Meanwhile, there are uncertainties on the impact the current Bank of Canada Governor Carney will have on the bank when he takes up the head job later this year. The Bank of England minutes could trigger some deeper sell-off in the pound, in particular against the euro should it deliver a dovish message. At the February meeting, the Bank of England kept the bank rate at 0.5% and the size of the asset purchase programme at £375 billion. Surprisingly, the central bank delivered a long post-meeting statement, stressing that the Monetary Policy Committee stands ready to provide additional monetary stimulus if warranted. Another focus will be the Federal Open Market Committee minutes, and focus will be on whether policymakers have discussed slowing the pace of the open-ended Key 3 asset purchases. The New Zealand dollar was weighed down by Reserve Bank of New Zealand Governor Wheeler's comments today, and recovery in Australian dollar New Zealand dollar helped lift the Aussie mildly elsewhere. Wheeler warned that, when the New Zealand dollar is coming under upward pressure, we want investors to know that the Kiwi is not a one-way bet. And he noted that the Reserve Bank is prepared to intervene to influence the Kiwi, even though, given the strength of recent capital flows, we can only attempt to smooth the peaks. He said that the G3's ultra-loose monetary policies are aimed at stimulating growth but also have significant spillover effects, and many other countries are affected as investors sought higher yields. Nonetheless, Wheeler noted that limitation of intervention and a Swiss-style cap isn't practical for the Kiwi. Finance Minister English also said last week that weakening the Kiwi through intervention against large-scale speculation is out in the war zone with a pea shooter. The New Zealand dollar was also weighed down by producer price index data, with PPI inputs unexpectedly dropping 0.3% quarter-on-quarter in Q4, while PPI outputs also unexpectedly dropped 0.1% quarter-on-quarter in Q4. Australian Conference Board leading indicator dropped 0.1% in December, while the Westpac leading indicator rose 0.2%. In Japan, the trade deficit came in slightly larger than expected at 0.68 trillion yen in January. The non-seasonally adjusted deficit reached a record high of 1.63 trillion, extending the run of deficit to a record 7 months. The overall balance was viewed as worse than expected, but the details were not that bad. Exports rose for the third consecutive month by 3.6% non-seasonally adjusted. Non-seasonally adjusted exports also rose 6.4% year-on-year, after dropping for 7 months since last June. Imports rose 1.4% month-on-month seasonally adjusted and 7.3% year-on-year non-seasonally adjusted. The data showed that Japan's economy is possibly forming a solid base for growth in early 2013. Bank of Japan board member Morimoto said that the central bank will implement unprecedentedly large monetary easing this year. Eyes are still on who will Prime Minister Abe nominate to succeed Bank of Japan Governor Shirakawa. In China, foreign direct investor dropped for the 8th month in January by 7.3% year-on-year to $9.27 billion. Meanwhile, non-financial outbound investment rose 12.3% year-on-year to $4.91 billion. Though the data was somewhat